Hello, everyone. Good morning to everyone as well, and thank you for joining us. I'm Honor from the Bite the Ball and Consulting, and I'm here to guide you through IFRS 15 recognition. This training is specifically tailored for the Lakeside Leisure Resorts as we navigate to the new CSA regulatory requirements together. Over the next 20 minutes, we'll cover everything you need to understand about this critical transition. So here's what we cover today. We will start by examining our current position and the regulatory context driving this change. Then we'll dive into the IFRS 15's five-step model, walking through each step with real examples. We'll analyze practical case studies relevant to our resorts operations, discuss special topics like loyalty programs, assess the impact on Lakeside specifically, and outline our implementation roadmap. Um, We'll finish with a quick knowledge check and time for your questions as well. So let's see where Lakeside stands today. We're in an excellent position, 325 million dollars in annual revenue with solid 10% growth year over year. Our operating margin of 22% is healthy, and most impressively, our customer loyalty index sits at 87%, showing our guests truly value what we offer across our Ontario lakeside properties. However, the Canadian Securities Administrators have introduced new regulations requiring us to adopt the IFRS 15 for revenue recognition. This isn't optional, but it's a regulatory requirement, and it's not just a paperwork exercise. This standard could materially affect how and when we recognize the revenue, which means it could impact our reported financial performance. That's why understanding and implementing it correctly it's absolutely critical. So you might wonder why regulators made this change. So IFRS 15 brings four major benefits. The first one is consistency, transparency, comparability, and the regulatory compliance. Um, so their fundamental shift here is that the revenue recognition is now driven by the transfer of control to the customer, not the older concept of transfer risks or rewards. So this is a meaningful change in how we think about when to recognize revenue. So IFRS 15 provides a straightforward five-step model that applies to every single revenue transaction. Let me walk you through each step. So step one is the identifying the contract with the customer. Do we have an enforceable agreement? Are the terms are clear? So the second step will be the identifying the performance obligations in that contract. What specific goods or services have we promised to each other? So the step three will be to determine the transaction price. What's the total amount we expect to collect, including any variable consideration. Step four will be allocating the transaction price to the performance obligations. How do we split the total price among the different promises we made? Step 5 will be recognizing the revenue when or as we satisfy each performance obligation. When we have when have we actually delivered on our promises? And these five steps apply whether we're dealing with a simple one-night room booking or our most complex vacation package. The beauty of this framework is the consistency. We'll now explore each step in detail. So, for the first step, the identifying contract, it requires us to confirm we have a valid contract. Um, Under IFRS 15, five criteria must be all met. Both parties must have approved the contract and be committed to perform. Um, A guest inquiry isn't a contract, but a confirmed booking is. So we must be able to identify each party's rights regarding goods or services. So payment terms must be clear: how much, when, and how. The contract must have commercial substance. It must change our economic position. And finally, we must believe collection of the consideration is probable. For Lakeside, this is generally straightforward. When a guest makes a confirmed boom looking, um, reserves a spa package, signs an event contract, or books a dinner, these all qualify as contracts once confirmed. Even verbal agreements can be contracts if these five criteria are met. So, however, if a guest has a history of non-payment, we might question whether we truly have a valid contract or under IFRS 15, even if they book it. So when it comes to step two, it's often the trickiest part because we need to identify each distinct performance obligation in the contract. A performance obligations, it's simply a promise to transfer a good or service to the customer. The critical question is it distinct? The something is distinct if it meets two tests. So first, the customer can benefit from its own or with order readily available resources. This is the capable of being distinct. Second is our promise to deliver it separately identifiable from other promises in the contract. So this is the distinct within the context of the contract. Here's a practical lakeside example. The say a guest books our weekend getaway package that includes a 3 night room stay, breakfast each morning, and spa treatment. So that's three distinct performance obligations because the customer could have booked each separately and each provides independent value. However, if you're providing daily housekeeping during the stay, that's not a separate obligation. It's part of the room performance obligation because it's not separately identifiable. This matters because of the we need to account for the all allocate price to each distinct obligation separately. So step 3 asks, what's the total transaction price? This is the amount we expect to receive in the exchange for transferring goods and services. It sounds so simple, but there are several important considerations. First, to variable consideration, we must estimate and include discounts, rebates, potential refunds, incentives, and bonuses. But there is a constraint: we should only include amounts we are highly confident won't be reversed. So the second, if there is a significant financing component, like if a guest pays in installments over time, we need to consider the time value of the money. Third, the non-cash consideration needs to be measured at fair value. And finally, any consideration we pay back to customer reduces the transaction price. So the key here is that we are making estimates upfront based on what we expect, not waiting to see what actually happens. This requires judgment and documentation. So step 4 is about allocation, dividing the transaction price among the performance obligation based on their relative standalone selling prices. The standalone selling price is what we charge if we sold that item separately. So we have several methods to determine the standalone prices. The observable price, what we actually change when it's sold separately, it's preferred. If we don't sell it separately, we can use an adjusted market assessment approach, looking at what competitors charge for similar services. Or we can use expected cost plus a reasonable margin. So the residual approach, backing into a price, is only allowed when the price is highly variable or uncertain. So the allocation formula is straightforward. Um, Take each item's standalone price, divide by the total of all standalone prices, and then multiplied by the actual transaction price. This proportionally allocates any package discounts across all the services. For example, if package standalone prices total 1,000 but we charge 900, each service gets a 90% of its standalone price. Step 5 is where we actually record the revenue. Um, but timing is critical. So IFRS 15 gives us two options: to recognize revenue over time or at a point in time. So we recognize revenue over time if one of the three conditions is met. Most commonly for us, the customer simultaneously receives and consumes benefits as we perform. Think of multi-night stays where guests enjoy each night as it's delivered. Alternatively, we are creating enhancing the asset the customer controls. Or what we're creating has no alternative use to us and we have an enforceable right to payment for work completed to date. We recognize the revenue at a point in time when control transfers to the customer. Indicators include we have a present right to payment, the customer has legal title and physical possession, and the customer has the significant risks and the rewards of the ownership. So for Lakeside, room stays typically qualify for overtime recognition. Guests consume the benefit each night, but spa treatment or dinner is point in time recognition controls transfers when the service is completed. So this means different parts of a package might be recognized at different times. So we have a little case study. Let's apply everything we learned with a realistic case study. So a consumer books our summer escape package for 1,500. This package includes 4 nights in a lakeside suite that normally costs $300 per night to 1,200 standalone value. Uh, Two spa treatments at 150 each, that's 300 standalone. A welcome dinner worth $100 of standalone, and the early check-in service valued at $50. So, and add up all the standalone prices: 1,200 plus 300 plus 100 plus 50 equals to 1,650, 1,650 total value. But our package price is 1,500, so the guest is getting a $150 discount, about 9% off. So the question is, how do we apply IFRS to 15 to account for this transaction? Think about our five-step model as we work through this. So, step one, do we have a contract? Absolutely. We have a confirmed booking with payment received, rights and payments term are clearly identified, commercial substance exists, and collection is probable. So yes, we have a valid contract. Step two, performance obligations. We need to identify each distinct promise. So we have four distinct obligations here. The 4 night stay is one obligation. Each one of the two spa treatments is separate obligation because they occur at the different times. So the welcome dinner is distinct and early check-ins is distinct. Why? Because the customer could benefit from each mm, independently and each separately identifiable. So we have a four distinct performance obligations to account for. Now the step three and four, like step four gets interesting. We allocate this 1,500 based on the standalone prices. Here's the math. The fortnight stay, we take 1,500 and multiply it by the room's share of the total value. So it's gonna be the 1,200 divided by $1,050, which equals to 0.727 times 1,500 equals $1,091 allocated to the room. So for the two spot treatments, we take 1,500 times 300 divided by $1,650. That's $273 for both treatments. For the welcome dinner, 1,500 times $100 divided by $1,650 equals 91. And for early check-in, 1,500 times 50 divided by $1,650 equals to 45. So notice something important, that the 150 discount isn't arbitrarily assigned. It's proportionally allocated across all four services based on their relative value. So the room gets the largest share of the discount because it represents the largest share of the value. So finally, step 5, when do we recognize the revenue? Different timing for different obligations. Um, the 4-night room stay worth 1,091 is recognized over time. We we'd like to recognize 272.75 each night as the guest stays because they're simultaneously receiving and consuming the benefit each night. Two spa treatments totaling 273 are recognized at the point in time when each treatment is completed. Control transfers when the service ends. The welcome dinner worth $91 and the early check-in worths are $45 are both recognized at the point in time when those services are delivered. Dinner when served, check-in when performed. So from one package, we have multiple recognition points. This is perfectly on normal under IFRS 15. Revenue recognition follows performance, not payment. So for the loyalty programs, the key principle is the loyalty points equals to separate performance obligations. Um, the accounting treatment is to estimating the standalone value of points awarded. Differ revenue equal to points value. The considering expected redemption rate and the recognized when points redeemed or expire. So the Lakeside impact is with the 87 percent loyalty participation. The proper deferral accounting is critical for accurate reporting. So for a practical example, here's how it works in the practice. A guest stays 3 nights at $250 per night, paying us $750. So they earn 500 points with an estimated value of $25. And based on historical data, we expect 8% point will be redeemed. So the accounting is 25 times 80%, which is $20 as a contact liability. So we recognize the room revenue now as $750 minus $20, which equals to $730. So as the guest stays over the 3 nights, that $730 is recognized, not the full 750. In the future, when the guest redeems points worth $20, we recognize that $20 deferred amount. So the remaining $5 represents the breakage, the 20% we don't expect to be redeemed, and we recognize that $5 when it becomes clear redemption, it's unlikely. Impact analysis for the Lakeside. The key changes expected is the revenue timing, package accounting, the advance deposits, loyalty deferrals, the variable consideration, the systems enhancement, and the monitoring 22% operating margin during the transaction is critical. So the common challenges, it's usually the identifying the performance obligations, the standalone selling prices, variable consideration, system limitation, and training needs. So we have a small question right here. The knowledge check question one will be the customer books a 3 night stay and earns 500 loyalty points worth $25. When should the loyalty points revenue will be recognized? So, is it A, immediately upon booking, B, over the 3 night stay period, C, the when the points are redeemed or expire, or D, at the check gets out? Think about it. So the correct answer will be C, when the points are redeemed or expire. Let me explain the logic. The loyalty points are the separate performance obligation distinct from the room stay. Uh, we have promised the customer future benefits, so we cannot um, recognize the revenue until we deliver those benefits. For the implementation roadmap, okay, key takeaways. So let me summarize the critical takeaways from today. The five-step model, the control-based revenue, recognizing the when customer obtains control, the performance obligations, proportional allocation, loyalty programs, and the documentation critical. For the next steps and the resources, immediate actions for you will be the reviewing today's materials and the identifying the questions, attending the department-specific workshop sessions, um, and documenting the current revenue processes. And the available support will be here on the finance team office hours, IFRS 15 guidance shared drive, and the external consultant support. So if you have any questions, that's the time for your questions. But thank you so much for your participation, and together we're gonna ensure a seamless transition to IFRS 15. Thank you so much.